Opendoor Technologies, NASDAQ OPEN, trades at a live price anchor hovering around the $2 to $3 range, a stark reflection of a market caught in the crossfire of past high interest rate trauma and severe institutional skepticism. To the casual retail investor scrolling through popular trading apps, Opendoor is frequently written off as a broken pandemic-era experiment, a digital middleman that got caught holding the bag when the Federal Reserve aggressively hiked rates from 0 to over 5%. Financial media headlines love to frame the iBuying sector as a failed Silicon Valley venture that tried to disrupt real estate with algorithms and failed, but this prevailing narrative completely misses a monumental structural reality. Opendoor is not merely a tech-enabled house flipper, it is the premier digital logistics and marketplace infrastructure engine for an asset class that has historically resisted liquidity. While Wall Street focuses on near-term macroeconomic jitters and the sluggish pace of existing home sales across the United States, smart money heavyweights are quietly evaluating the physics of transaction velocity, broker commission monopolies, and the inevitable return of macroeconomic rate normalization. The real market mispricing lies in the fact that investors are pricing Opendoor as a distress liquidation play, while completely ignoring its emerging evolution into an asset-light, fee-generating marketplace platform capable of scaling efficiently without inflating its own balance sheet. The daily trading volume in Open reveals a classic battleground dynamic where macro jitters and algorithmic short selling keep retail sentiment subdued. Every time the bond market reacts to sticky inflation prints or a hawkish Federal Reserve statement, growth-adjacent real estate tech stocks experience sharp emotional sell-offs. Institutional heavyweights utilize these artificial liquidity vacuums and artificial pullbacks to accumulate shares quietly, often through block trades and structured accumulation phases, while retail traders get shaken out by short-term volatility. This tug-of-war between patient capital and impatient retail panic creates massive valuation dislocations that do not reflect the company's underlying operational progress. Before we break down the operational evolution and the mechanics of how digital real estate is restructuring the American housing market, drop a comment below and let me know, are you currently holding shares of Opendoor, or are you waiting for a deeper pullback before taking a position? To understand where Opendoor is heading, we have to look past the outdated historical framing of the company as a legacy iBuyer that takes on massive directional real estate risk by buying homes directly onto its balance sheet. When Opendoor scaled, its primary engine was the principal-heavy iBuying model, where the company acted as the direct buyer of last resort, purchasing single-family homes, renovating them, and reselling them to retail buyers. While this generated rapid top-line revenue during the zero-interest rate environment of 2020 and 2021, it exposed the business to catastrophic inventory write-downs when mortgage rates doubled almost overnight in 2022. The modern high-growth demand vector driving the business today is fundamentally different, the evolution into a hybrid marketplace and multi-channel platform. Opendoor is aggressively pivoting toward asset-light offerings, most notably its marketplace model, which connects everyday home sellers directly with institutional buyers, local cash buyers, and retail purchasers while facilitating seamless title, escrow, and financing services. Instead of absorbing 100% of the home price risk on every transaction, Opendoor is building the transactional rails, the digital operating system for the multi-trillion-dollar residential real estate market. By embedding third-party market participants, listing agents, and financial institutions into its ecosystem, Opendoor generates high-margin fee revenue on services, vastly improving its unit economics and insulating the balance sheet from extreme cyclical housing drawdowns. Looking toward the multi-year horizon, Opendoor's future outlook is defined by several massive growth catalysts, technological gatekeeper positioning, and macroeconomic shifts. As mortgage rates eventually stabilize and begin a multi-year descent from their cyclical peaks, housing market liquidity is projected to unlock significantly, releasing pent-up demand from millions of homeowners who have been locked into low-rate mortgages and reluctant to move. Opendoor sits squarely at the center of this impending liquidity surge as the definitive digital gateway for seamless home transactions. Furthermore, the company's proprietary pricing algorithms and automated valuation models, or AVMs, represent a deep technological moat. Accurately pricing a localized residential property requires parsing millions of disparate data points, from local zoning laws and school district ratings to subtle neighborhood pricing trends and micro-market liquidity shifts, a task that traditional real estate brokerages still handle with manual, inefficient comparative market analyses. By scaling its platform, Opendoor acts as the indispensable digital infrastructure layer that eliminates the traditional 6% broker commission stranglehold, replacing it with a transparent, friction-free digital checkout experience. Naturally, risks remain. Unexpected spikes in 10-year Treasury yields, prolonged housing market stagnation, regional regulatory headwinds, and potential execution missteps in scaling its partnership networks pose ongoing challenges. However, mega-cap tech spenders and venture capital ecosystems are increasingly realizing that real estate remains one of the last major analog industries ripe for digital transformation. For the discerning investor willing to look past short-term price noise and macro headline panic, Opendoor represents an asymmetric opportunity in the digitization of the world's largest asset class. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly.